Well, when we look at equity markets, as we just did for the month of February, it's a bit of a change from how we kick things off to the year in January with that strong start. Let's check in with Brian Belski, Chief Market Strategist at Bank of Montreal. Thanks so much for making time today, Brian. We were just looking at the performance of the TSX, the S&P 500, and the NASDAQ for the 1 month. The TSX lagging a bit, the NASDAQ the strongest there. What did you make of the performance over the last month?
Well, good afternoon, Canada. Thanks for having us, Jacqueline. It's the old classic flippity flop. We had a great month of January.
Is that the technical term for it, Brian?
I think I just made that up here in New York City today. The flippity flop.
Yeah. Well, you're not in Florida. See, that would have made more sense, maybe. The flippy floppies.
Well, we're in the flip flops. Yeah, exactly. No.
Let's get to business.
So think about this. So there's such a binary nature of investors, Jacqueline, right? So, oh my gosh, things are good. We love things in January. Stocks go up. Oh no, we've had a change. Stocks go down in February. So January up, February down. There doesn't seem to be a lot of long-term wisdom to this. I think the big thing that we saw in February was terminal rates with respect to interest rates obviously were pushed a little bit higher. There seems to be a tug of war between bonds and stocks at the bond market, especially where the 10-year Treasury is, Jacqueline, with respect to being stubbornly below 4%. I mean, the bond market and bond investors seem still to think that we're going to see some sort of a massive drawdown in the economy. That's what kind of tells us. But at the end of the day, markets are still positive year to date. So let's take that for what it is, number one. Number two, I think from a near-term basis, especially in the S&P 500, that 4,000 number was an important number. And we closed slightly below that, obviously, here today after some weakness last week, but obviously a pretty decent day yesterday. Lastly, in terms of the NASDAQ and in the U.S. stock market outperforming Canada, remember Canada had a heck of a run last year. And in January, actually, many of the sectors in Canada that are more closely tied to the U.S., namely technology, consumer, did very well. And so I think this is a market of stocks and not just just a market overall. Meaning, what does that mean? You don't want to be, I don't think, chasing the TSX overall. You want to be buying particular sectors and stocks in the TSX. Same thing with the U.S. market. So it's not just as easy as buying a very broad ETF. We think we want to be more stock picking, more quality, more value, more growth at a reasonable price, especially considering the volatility that obviously has defined trading activity so far in 2023.
And one filter that you're using, Brian, to sort of look at Canadian companies right now is looking for that dividend growth.
Yeah, we love dividend growth companies. Canada is very blessed to have this long lineage of companies that pay dividend growth. And I think the lineage from the UK obviously kind of has followed through into Canada. And the key to dividend investing, in our view, is not just to buy companies with high yields, Jacqueline, but those that are able to grow their yield and payout ratio over time. And how we screen those out, quite frankly, is to try to look for companies that have increasing cash flow. So cash flow yields above the dividend yield. And if you can find a company that has a combination of buybacks and dividend growth, that's really, I think, a great place to be. That shows that the company is really centered on their business and really believes in itself.
We were talking yesterday about Intel cutting its dividend. Not that it was yesterday, but we were chatting about it yesterday as well. So do you think that that could be a risk, though, in these sort of conditions, that other companies would be considering cutting their dividend?
It's a great question. We sold Intel mid last year from all of our portfolios. And the reason is that we saw, kind of from a fundamental perspective, it lagging behind its big brothers and sisters in the semiconductor market. And I think there was a time in 2021, Jacqueline, that all you want to do is own semiconductors. And now I think, obviously, from the multiple compression that we saw in names like NVIDIA and AMD, Intel, just from a fundamental perspective, didn't fit how we wanted to own the semiconductor space going forward, irrespective of what we've seen and heard from the CHIP Pact with respect to the U.S. government and bringing back fabs to the United States. I think Intel's kind of, from a fundamental perspective, well behind its other leaders, including NVIDIA, AMD, and even Texas Instruments.
And so beyond what you're looking at there, M&A, you think that that's going to be a big theme for this year, Brian? Where do you think that's going to show up the most?
Well, I do. And one of our favorite sectors is communication services. And we call it the 3 Cs in terms of the theme: cash, content, and consolidation. In Canada, you're very blessed. You have this thing called Crave. Crave's amazing, right? You can just watch anything you want. But in the United States, like myself, if I'm sitting at home in Florida, I have like 9 or 10 streaming things that I have to pay, and that's not going to continue. So I think you're going to see some consolidation in the streaming companies. That's not number one. I think there's more consolidation coming in the healthcare sector, especially considering the large balance sheets and cash flow that healthcare has. And then lastly, I would say financials and kind of technology, because I do believe that scale is very important in financials. And so I think to scale up your assets, whether or not it's a couple of more regional banks getting together or some other instruments buying, let's say, asset managers or brokers, I think that's going to be a major theme in 2023.
And lastly, Brian, I just wanted to get your thoughts on Canadian GDP today, because we've had some really interesting conversations about it on the show today. We heard from Mark Wiseman talking about how he's concerned about productivity in this country. And so the data today showing a slowing in the economy, well, flat for the quarter, for the fourth quarter. He takes concern with that, beyond, yes, that it would mean potentially that inflation is going to get under control, maybe a little bit faster, potentially. We also heard from Derek Holt from Scotiabank, who says that he thinks that the economy is going to pick up some more from here because it was really just about some distortions in the data. But when you're thinking about the Canadian economy and Canadian companies from here, how do you think, what do you think the future's going to hold?
We follow what our great economist Doug Porter says with respect to BMO. It's kind of somewhere in between, maybe more toward, I think things are a little bit better and the consumer remains very strong. And in January was a pretty good month. Remember, GDP is a lagging indicator. And the consumer in Canada is very, very strong. We've seen from a company perspective, a lot of our great consumer companies in Canada, whether or not it's QSR or Canadian Tire or Aritzia, aside from its inventory issues, and even Couche-Tard do very well with respect to their fourth quarter numbers. So I think that the consumer in terms of Canada remains very strong. And I think the economic perspective in Canada is a lot stronger than most people think.